Hi, I'm Greg Brown. I'm Executive Director of the Kenan Institute of Private Enterprise and Finance Professor here at Kenan-Flagler Business School. So I want to talk today about a very interesting paper that was put out by AQR a few weeks ago, looking at expected returns in private equity. So this paper has generated quite a bit of controversy because one of the results in this paper suggests that when properly risk adjusted, private equity returns have been lower than public market returns over the last couple of decades. So I want to dig into this result a little bit more to see if we can figure out why is it that this paper comes to a conclusion that seems to be different than what much of the academic literature has been suggesting for the last decade or so. So what the authors do is dig into exactly how you should be thinking about the risk associated with private equity. And there's several things that are different about typical private equity funds and firms that are part of buyout transactions. The first one is they tend to be more levered. So a typical buyout transaction will put more leverage onto a company, which makes the equity riskier. Two other important effects are they tend to be smaller companies. They tend to be value-oriented companies. Both of these are things that we know historically have led to higher equity returns, perhaps because smaller companies and value companies are riskier than other companies. So let's try to unpack this and see if this helps us resolve what's going on with these differences. So the first one is the leverage. So it's definitely the case that buyout firms take on leverage and that makes the equity riskier. What's less obvious is that these companies tend to have safer assets, so their asset betas tend to be lower. So the amount of leverage that you put on these companies doesn't result in as much risk as you might expect putting the same amount of leverage on a typical public company. So when you do this calculation, the authors come up with a beta of about 1.2 versus 1.0 for the market as a whole. That actually is a pretty reasonable number and pretty consistent with what other academic studies have found for betas. So no qualms there. Let's talk about the small and value aspects though. So certainly typical buyout firm would be a small cap, even a micro cap company. And we know that historically those have had higher returns. Likewise, there's going to be a big value tilt. They're going to be kind of more stable cash generating types of companies. So the right index for the comparison probably isn't a large cap index like the S&P 500, which is the one most commonly used in academic studies, but maybe something that has a specific small value tilt. So the authors use the Russell 2000 Value Index as a benchmark and then lever that up by 1.2. When they do this in their Exhibit 1, they actually find results that look pretty favorable to private equity. Over a reasonably long time period, private equity still performs pretty well compared to the levered Russell 2000 Value Index. But then in the Exhibit 2, they do what's called a public market equivalence calculation. In fact, they pull this data from another paper that was published a few years ago in the Financial Analyst Journal. And they show there that when you make this adjustment for size and industry, that you end up with a PME that's less than 1. A PME less than 1 means that the public markets did better than the private markets. So one shortcoming of that analysis is that this FAJ paper, which was a very good paper and widely read, did have the limitation of being just funds that were part of the portfolio for large public pension fund. And so therefore the period was a little bit shorter, and it's also a few years old now. So one of the nice things that we have here at UNC is affiliation with the Private Equity Research Consortium, which gives us access to the Burgess Data. And the Burgess Data basically has all institutional quality funds going from the 1980s all the way up to the present. So we replicated this calculation of calculating PMEs with a levered Russell 2000 Value Index for the full period from 1987 until the present, and found that the PMEs were actually 1.09, greater than 1, suggesting that private equity has outperformed the public markets. And furthermore, one of the points made in the AQR paper is that there's been a decline in performance of private equity over time. And this is evident in the Exhibit 2 in their paper that shows that from the 90s until the present, there has been a clear decline in PMEs. However, if you extend the sample all the way back to the 80s, you see that there's been much more variation than is apparent in that graph in private equity. There are periods of quite poor performance from the vintages around the tech bubble, and then strong performance in the 90s, which is where the graph in the AQR paper starts. If you look over this long horizon, then you see that the average really has been around 1.1. In fact, the years from 2004 to 2015 vintages, that average of 1.1 is about identical to the long average of 1.09. So in summary, I think that it's a very interesting paper, and certainly many of the points the AQR paper makes about earnings looking forward, what multiples are right now, should lead us to wonder about what returns for private equity are going to be going forward. But looking at the long horizon, even risk adjusting for higher leverage, small company, and a value tilt, we find that private equity has historically done quite well. So for additional details, I refer you to my blog and suggest that you read both the AQR paper and these additional results that come from the Burgess data.